I would like to thank the sponsor of today's episode, the Keystone Group. The Keystone Group is a results-oriented management consulting firm. Using small, experienced teams, they help mid-market manufacturing, distribution, and service companies develop and execute strategy, improve operational performance, restructure finances, and when it comes to mergers and acquisitions, their team can help you with the assessment, planning, and integration. I recently had the pleasure of interviewing Jeff Alvis of the Keystone Group, and they have helped countless companies avoid the pitfalls and maximize the value of their acquisitions. If you're in need of rapid and sustainable results, don't hesitate to reach out to the Keystone Group at thekeystonegroup.com, and hope you enjoyed today's episode.
Looking to buy, sell, or grow your business to position it for a sale? As the owner and managing partner of Sun Acquisitions, Domenic Rinaldi has personally been involved in over 300 M&A transactions. He has seen and done it all, consulting with large and small businesses across a broad range of industries. On M&A Unplugged, he'll interview buyers, sellers, and their advisors about their experiences scaling, selling, and acquiring businesses. On every episode, you will get key learnings, but most importantly, you will be better prepared for your own acquisition or sale. This is M&A Unplugged with your host, Domenic Rinaldi.
M&A Unplugged community, we are being joined today by Jim Oliver, the owner of CreateTailwind, the host of the podcast Breakaway Wealth, and the foremost expert on the infinite banking concept. Now, if you're like me, you might be saying, what exactly is the infinite banking concept? The concept was developed back in the 1980s by R. Nelson Nash as he was struggling to become financially independent. Jim spent 12 years under the tutelage of Mr. Nash, learning how best to leverage this concept. And leverage it he has. Jim has built a successful business helping other people adopt this concept. He has acquired businesses and real estate using this platform, and now he speaks all around the country about the benefits of the infinite banking concept. Jim, welcome to the M&A Unplugged, and I look forward to having you unpack this concept for our listeners so they can perhaps leverage this opportunity in their own businesses for growth and acquisition.
Thanks, Domenic. It's great to be with you guys this morning, and look forward to going down this path and telling you how I've used infinite banking and how you can use infinite banking as well for real estate, businesses, all kinds of stuff.
Yeah, I'm so excited to have you really go through the details and explain this to the M&A Unplugged community. But let's start first with CreateTailwind. Talk a little bit about your business and what you do, and then we'll get to the infinite banking concept.
Absolutely. So, Domenic, in 1988, I started in the financial services industry, and I learned how to do financial planning the old traditional way, and fee-based planning and building these 200-page plans with leather binders and modern portfolio theory and Nobel Prize winning theories on investing and blah, 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 right? Well, about 15 years into doing that, I realized that when we were doing the math, our average rates of return looked pretty good, but our actual rates of return and the net rate of return didn't look very good. And what I mean by that is it was about 9.38 was our average rate of return at that time when we were looking back over 10 years. And the actual rate of return was around 4%.
So, Jim, hey, can you just explain to the M&A Unplugged community, what's the difference there? What's the difference between your average and your actual? How do you have such a delta?
Sure. Here's the easiest way for me to explain that is we're going to go 4 years, Domenic, okay? And I'm going to give you an example. Let's say I have $100,000, and in the first year, I gain 100%. So now what's my balance?
200.
200. The next year, I lose 50%. I'm back to my 100. The third year, I gain 100% again. Now I'm back to 200. And in the fourth year, I lose 50%. So I still have the 100,000 that I started with 4 years later. And what's my average rate of return? Well, it's 25% because I was up 200% and down 100%. That's 100% average positive. divided by 4 is 25%. So my statement would say that I earned 25% over those 4 years. My balance would say that I earned nothing. That's average versus actual. Now, it's much more subtle in the real world, Dominic, but it's, when somebody says, oh, this fund is averaged 8 point something percent or 12 point something percent, that doesn't mean that's the actual rate of return. Because of the downturns in the market, that affects it it's not what you think. So if you've ever noticed in a prospectus, the fees are over maybe 4 pages to 10 pages. And it's really hard to understand all of the fees. I've never run into anybody actually that can tell me all of the fees and all of the cash drag and everything else in their investments. So you take average versus actual, you take taxes, you take the fees, you take all that stuff out, and really the net of the growth in your account, that's your net rate of return, your actual rate of return.
So I understand. So you're in the financial world, you're managing accounts and you're living through this. I'm assuming you picked up your head one day and go, wow, this just doesn't feel right to me. We're promoting these average returns, but our actuals are less, and there must be a better way.
There must be a better way. So then I looked at my clients that were truly wealthy and had built wealth from the ground up, and a lot of times in a relatively short period of time. They were in 2 categories, businesses and real estate. That's just where they happened to be at that time when I analyzed it. And I thought, well, that's interesting. What prevents people from buying businesses? Or how do people buy businesses? How do people buy real estate? How do people find these HUD loans at 100% for a 100-unit apartment complex for 40 years at 3%? How do they do that? How do they buy businesses on an earn-out basis? Or all of these things, like, wouldn't I rather put my money towards those assets versus those financial instruments that I don't control? That's where that journey started.
Got it. And so is it at that point in time that you met R. Nelson Nash, or how did you get exposed to the infinite banking concept? And let's talk a little bit about what is the infinite banking concept.
So it's about that time that I had some friends that were aware of infinite banking, and I tried to get the concept and understand it from them. My paradigm as a financial planner was so in cement, I struggled to understand it, and I flew to Houston to see R. Nelson Nash in person. And
Wow.
By the way, before I did that, I bought the CDs and I listened to them. And I didn't get the impact. But when I met Nelson in person and he walked me through for 9 hours, this class was 9, maybe it was 12. It was either 9 or 12 hours over 2 days. And it was like a light bulb went off. It's like, this is what I'm missing. Like, this is the missing link to going out and buying real estate and buying these businesses and taking over the banking function in my life. So what is the infinite banking concept? The infinite banking concept is that taking over the banking function away from commercial banks to a banking system that you control. Now, Dominic, you do it with a certain type of insurance contract. So sometimes as soon as I say insurance contract, people have this paradigm and this view of, oh, it's insurance. I've heard insurance doesn't have a good rate of return. It doesn't have this. It doesn't have this. But life insurance agents are not trained to design insurance contracts the way that you design it for a corporation or for a bank, or for that matter, for infinite banking. And they're not trained of why and how loans work against that policy. And that's a big word, against, because what most insurance agents that are licensed selling this stuff, they don't realize that when you take a loan from your whole life insurance policy, but it has to be specifically designed to be cash oriented. But when you take a loan, your money does not leave your account. Your money stays in your account, compounding uninterrupted, while you borrow the insurance company's money to go invest. Now, the infinite banking concept was started to pay off debts and things like that. The way that we use it at CreateTailwind is to build wealth. So you take the insurance company's money and you put it in the apartment complex.
So, Jim, before we actually get into how you use the money to acquire businesses and real estate, let me go back to a couple of things. So, you mentioned you become your own bank. Immediately, I'm thinking, and maybe the M&A Unplugged podcast community is thinking, wait a minute, become my own bank? That sounds awfully difficult. We know all the regulation that goes into it. It's risky. Like, sort of alarm bells go off immediately when you say, create your own bank. Explain that to us. How does that happen? And is it really a true bank?
It is not a true bank. It is a money pool. The more appropriate term would be I build my own money pool that I can collateralize and use other people's money to build my wealth.
And so obviously it's not a fixed structure, but is it an entity that has this money pool? What is the formation? What does the bank actually look like?
So the bank is owned individually. Okay, because there's certain things that you want, like creditor protection, et cetera, that is afforded inside of a life insurance contract in most states. But you own it individually. You could loan it to an entity that you own or control, and then that entity could put it to work. Okay, but it is a contract with a mutual insurance company. And the only reason that we have to use a mutual insurance company, or not the only reason, but one of the big reasons, is mutual insurance companies are owned by the policyholders. And the company is required by law to distribute the profits of that company to the owners, the policyholders, in the form of a dividend, which is not taxable. So we have this tax shelter that we're holding our money in, that we have access to other people's money because we have this contract. That is just like a banking system.
So interesting. So you're saying is you open up this insurance contract, and is it like a whole life insurance policy? What kind of insurance is it exactly?
It's a blend between a whole life policy and a rider called a paid up additions rider, which is a one pay policy. The whole thing can't be that since 1988 because the government changed the rules. But on taxation inside of a life insurance, and it has to have something at risk. So the one pay policy used to be, Dominic, you'd put in $1 and you had $1 you could take out, right? Now there's nothing at risk. There's no cost. By the way, audience, that's why you've never heard of this paid up additions thing, is because, Dominic, if I put in $1 and I could take $1 out, how much do you think they pay the insurance agent? Not much, right?
Right.
Okay. So insurance agents don't like it because there's no commission on that piece of it. So we combine that piece with the whole life policy to get it focused on cash. So it's the highest cash value legally available under the IRS code 7702 for life insurance contracts.
Understood. So without getting too far down into it, you open up an insurance contract, you have this additional rider, and basically that now becomes your platform for this infinite banking concept. Is that correct? Is that what I'm understanding?
Yep. Now that's your source of funds, that's your capital, right? Your money pool. Now then you start to act like a banker.
So let's use a real life example. So I take out this whole life policy, which I want to come back to, by the way, but I take out this whole blended whole life policy. And let's say my premiums are whatever they are, $3,000, $5,000 a month, whatever it is, right? This rider allows me to put in an extra tranche of money. Maybe I put in $100,000 or $200,000. Is that? Am I understanding that right?
Yeah, those ratios would be. It's more like 30 or 40% base, and then 60 to 70% paid up additions rider. But you got the right concept. Yes.
Okay, so I'm putting in this pool of money in addition to the premiums I'm paying in. And then what you're saying is, so now I have this platform to borrow money against, which is really the infinite banking concept. Yep. And now if I've put in between my premiums and my paid up rider, let's say I have $300,000.
Yep.
I can borrow against that $300,000 without touching any of the principal. So that principal stays there and continues to earn whatever the rate of return is that the mutual fund is earning. And do I get to borrow 100%? Do I get to borrow 50%? What percentage of the money can I borrow against?
Up to 100% of the money. And Dominic, that's the difference of having, like, if somebody's out there and they're saying, well, I have a bond account and I can I could collateralize that, or I have a stock account. A bond account, you can get about 80%, and a stock account, you can get about 50%. And you still have to get the bank to approve the loan, right? In this, there is no approval. You tell the insurance company, send me the money, and that's it. They have to. It's a unilateral contract.
And I'm assuming they're charging you interest, right? So
They are.
What is the interest rate that you're paying to access your money?
4 to 5% interest only, Dominic.
So and what is that based off of? Is that off of LIBOR? What is that? What is that based off of?
It's declared by the insurance company on an annual basis. But what they do is, to give you an idea, like, there's one of the insurance companies out there that we use, and we can use anybody, but there's one out there that their loan rate is 4.4%, and their dividend crediting rate is 5.4%, and they have a 4% guarantee. So when you look at all of this and you put together, and the dividend is made up of more than just that interest component. It's the mortality experience of the company. It's the expenses and the expense management of the company. And then they declare a dividend. But the dividend throughout history has always been higher than the loan rate. Okay, so now think about this for a second. If I'm using this for business purposes and it's deductible, then the money that I'm earning inside of my insurance contract is tax-free. It's growing tax-deferred, tax-free, can be tax-free. I say potentially tax-free because you can't let the policy implode down the road. Okay, and it won't as a whole life policy. That's why we don't use universal life or anything else, because those can implode. So your money's growing and you're not paying taxes on it, but the money that you're paying to the insurance company to use their money is deductible, just like it would be at the bank. And the difference is you're controlling it.
I see. And so that interest rate, so you mentioned 4 to 5%. Is that a variable rate? Is it a fixed rate? So when they come out with whatever the rate is for the year, did they lock that in, or can it float?
Once they lock in the rate for the year, that's locked in. But there are variable rates and fixed rates depending on the insurance company. That's why we use a half a dozen different companies, because our clients have preferences of, hey, I want a fixed rate. But there's a company out there right now that has a fixed rate of 5%. And I think that's pretty strong, because if you look throughout history of interest rates, having a locked in contractual for the rest of your life 5% interest only loan is pretty good, while your money is inside of there earning money tax-free. So 5% deductible, earning in there, even let's just say 5% tax-free. Well, I'm creating an arbitrage, and then I'm going to go make money. So when you look at it, if you think about this money pool and you think of this ledger, left side of the page, right side of the page, the left side is the policy, but now I have the use of somebody else's money to go buy a business, to go buy real estate. And I know we're going to go there later, but now those businesses or that real estate or that stock is going to make money, hopefully, right? So now I get both sides of the ledger, because I didn't lose my left side of the ledger, the policy. I just added the right side of the ledger, my behavior. So it's an and asset, not an or asset. Does that make sense?
Yeah, it does. I mean, so your money's continuing to grow, and yet you're borrowing against it at interest only, and you're writing off the interest just like you would with the bank, but you've preserved your capital and let it sit there and grow. Let me ask you, Jim, I got to ask you this question, because, you hear it, so, there are lots of rumors out there, and you hear people talk about whole life insurance. When you mention whole life insurance, I think for a lot of people, alarm bells go off. Well, I've always heard that's, a waste of money. It's very expensive. There's lots of fees. You don't really realize the value of your whole life policy unless you live, to 90 plus. Talk a little bit about this as an instrument and why people shouldn't be worried, or should they be worried a little bit about, the nature of a whole life policy.
So if you just took a whole life policy, and let's say after 20 years, and you looked at the rate of return, depending on the company, depending on dividends, in today's world, your rate of return, and by the way, dividends are down. They're lower than they've ever been because interest rates are so low, right? And we're getting paid from the It's not a universal life or a variable universal life where we're taking the money and putting it in the stock market or putting it in the index. And the reason we're not doing is universal life policies are just a projection. Failure can't be an option in this. So we use a whole life because it has a guaranteed growth, and then it declares a dividend every year. And the companies that we use have declared a dividend virtually every year for the last 100, 150 years, however long the company's been around. But the whole life policy itself over the next 20 years would say do 4 or 5% net. Again, remember net, not average, not gross.
This is actual.
Actual rate of return. Okay, so then we add this paid up additions rider, which is cash on cash. It's 100%. You put in $1, you have $1. That rider earns a dividend too. So now we're earning dividends on top of dividends, and we get the dividends paid in paid up additions. So it's a compounding effect inside the insurance contract the way that we design it. We design it to be the lowest death benefit, highest cash value available. And we can't use these other, and so in a whole life policy, by the way, Domenic, you get guaranteed, here's what my guaranteed cash will be, and here's what my current market condition, not projected. Universal life is projected. Projections mean nothing, right? It's kind of like when you go buy a business and you look at the P&Ls of what is this business doing now, not what could this business do. You would never buy the business on what could it possibly do, right? I mean, you're going to pay for the business if you're buying it from somebody else on what it's doing now.
Absolutely. We tell that to people all the time.
So that's why we like the whole life. It's like that. It's current market conditions, which are low.
What's very clear to me is that this is a complex instrument. It sounds like it has tremendous upside, but if people are going to consider doing something like this, they need an expert like you to really walk them through. And you've been there and done that. So you're drinking your own Kool-Aid. And so why don't we move there? When we first talked, you told me that you've been using this instrument to buy businesses and real estate. So I think what would be really helpful is let's talk about an example of where you used this infinite banking concept to acquire or invest in a business. I think it'd be very helpful to, put some structure and some real life scenarios around that.
Okay, so I'm going to give you an example. And this is, I've bought 9 businesses or started a couple of those 9. I own 9 businesses, but I've bought all of the businesses using this concept. But I'm going to give you one example. So I bought this company, and I bought it from a company that was a very large company, $100, $200 million company. And this little subsidiary of that company didn't fit in their overall kind of vision because it wasn't in line with what the bigger company was doing. It had its cool own little niche, and they had just gotten a VC infusion of about $20 million, and the VC group they wanted to be clean because what's their goal? Sell the company in 3 to 5 years, right?
Absolutely. And what industry is this business in?
It's in electronics. So it's electronics sales, refurbishment, and kind of reverse logistics. And so the other company was kind of like a high-end eBay, right? And so what we did is we bought this on an earn-out basis. We knew what the revenue was. We knew what the EBITDA was. And so we said that we'll buy it. We're going to give you a minimal amount up front, but then on the increase, we will then pay you 20% of that increase until we pay you $3.5 million, right? Okay, so Domenic, we only had to come up with $75,000 to close on this business.
And did that $75,000 come out of the infinite banking?
It absolutely
platform?
did. It absolutely did. So we bought this business. We took a loan from the insurance contract for $75,000 August 1st. And at the end of the year, because after Christmas, everything else, we had a $400,000 distribution. Okay.
Out of the company that you had acquired.
Out of the company that we acquired. Now, remember, everything else is on an earn-out basis. So how much did it cost me to buy this company? Well, number one, look at my rate of return. But my rate of return wasn't $400,000 on a $75,000 investment. My investment was interest to the insurance company for 4 months. That's it. So my rate of return is massive just at that point after 4 months. And then when that business gets a purchase order and needs some money to take care of the purchase order or whatever, I've loaned the company money. I take part of the profit. I'm 50% owner, but I'm also now I'm financing and I'm acting as the bank. So I use it for that.
So let me stop you there. So when you say there are purchase orders and you fund it, you meaning the infinite banking concept funds it. So you're taking withdrawal out and then you're paying yourself back. And are you paying yourself just the interest, or how are you paying yourself back? I'm sure there's some mechanism there.
Sure. What we did is we set up a 3-year amortization that we came up with. That was just what we wanted to do, because the insurance company does not set an amortization. It's interest only. So we said 3 years, but then at the end of the year, when we had this $400,000 distribution, we just paid the loan off at the end of the year. And then when we paid the loan off, then all we had as an expense to buy this company was the interest on the $75,000 for 4 months. Now that $75,000 is available to use again, which then we started a subsidiary of the smaller company to get into the cryptocurrency market in the form of manufacturing cryptocurrency mining computers. So we went and bought a bunch of parts and everything else, started this company, and that company grew wildly in 2018. Not so much in the end of 2018 and the beginning of 2019, the quote crypto winter we've been experiencing that we're kind of coming out of. But all of it was, then I used the money twice, right? I used the same money to buy the one company and start the other company.
So Jim, I mean, it's a fantastic rate of return. I mean, that's incredible, but there must be some downside, right? So if things hadn't turned out the way that you wanted them, let's say the business didn't do $400,000 of EBITDA and experienced, flat growth or a loss.
Yeah.
What happens inside of your infinite banking concept and the contract that you have? What would you have done at that point in time?
At the end of the year, so the August or the end of July the following year, I owe them 4.4% interest. So, and that is the downside. If the investment doesn't work out, it doesn't cash flow, but I had more money in there to help the business if it didn't, cash flow, and if it needed money, I had more money in there. But think of it like this, Dominic. This is a question I like to ask people. If I would loan you $100 million, okay, and your only obligation in 1 year, you have to pay me 5% interest. Now, you don't have to pay me any of the $100 million back, or you can pay part of it, all of it. But the only thing you're required to do is give me 5% interest. Would you take the money?
It depends on the circumstances, right? But at 5%, I mean, when you look at loans that are being given today, they're much higher rates than that, right? And you've got a principal and interest payment that you have to worry about. So if the circumstances were right, that sounds like a pretty interesting concept.
Yeah, and so you're exactly right, Dominic. If you knew what to do with the money, it'd be a no-brainer. So let's just play my little scenario. I take the $100 million and I buy $500 million worth of real estate, and I have a 6% cap, right? Okay, so I'm going to make 30. Now this again, this isn't a real life scenario, so it assumes I got that 6% for the whole year and everything else. I'm going to make 30, and I got to write you a check for $5 million. I'm okay with that, right? So that's kind of the concept. Is I'm going to use this other person's money or other entity's money, the insurance company, and I'm going to go make money with it.
Now, can the insurance company at some point in time call that loan? I mean, I'm sure if you start missing what happens if you start missing payments on the interest? What happens in that scenario?
Well, that's a great point. If I don't pay the interest, it'll come out of my cash value. Okay. If I get to the point where I don't have it in my cash value, it could lapse the policy. So there is a management and coaching, again, back to make sure you have the right coach to show you how thin or what margin and everything else that you can use for this. But if you borrowed 100% of it, then at the end of the year, you got to write them a check for the interest. you got to have that money, right? You have to have that interest payment. So, there's no free lunch in anything, right? I mean, there's always risk, but I've never had that be an issue with one of my clients because we always talk about that way before it's going to happen, or they're going to have the cash value, or they're making regular payments back to the loan. And when they make regular payments, like if they set up an amortization that they've decided on and they, are in control of, then they're going to have plenty of money in there to pay the interest.
That makes sense. That makes perfect sense. Boy, Jim, I'll go back to what I said earlier, and folks in the M&A Unplugged podcast community, definitely an interesting concept and an alternative way to look at potentially financing business acquisitions or real estate or a combination thereof, and many other things, working capital in your own business. Jim, if there's one big takeaway as we wrap up here, what is it that you would leave the community about, potentially using the infinite banking concept to fund acquisitions and real estate and to grow their businesses?
I would tell you that somebody in that equation is going to be the banker. And typically business owners use lines of credit and loans, amortized loans. And this is just an alternative bank that you control. And if you think, by the way, that, I'm using a bank and it's FDIC insured, and there's $88 billion in the FDIC reserve to protect depositors, and there's $7.1 trillion of deposits. So that's less than 1% that you're protected. So the insurance company is highly regulated and you control it. And I would leave you with this, Domenic, and I know you know this, is whoever controls the money makes the money.
Yeah, great point. Great point. So, Jim, if folks in the M&A Unplugged podcast community needed to get in touch with you, they were interested in this concept, how could they reach you?
Just go to CreateTailwind.com is the easiest way. We've got lots of great free material on there, and schedule a one-on-one meeting. In that meeting, there's no call to action and there's no close. My style in this is just to do what we've been doing today, is we educate you from soup to nuts, how this works, and then you decide, and then we give you some reading or some videos or whatever to watch or read or book. And then at some point in time, you either say this is for me or it's not for me. That's our style. That's our business model.
Jim, thank you so much. I really appreciated you being here today. I think this was, great information and eye opener for me, for sure.
Thank you for having me, Domenic. I love talking to people like your audience who are out there trying to break away from the herd and be different and build wealth.
Yeah. Thanks. Thank you, Jim. So to summarize just some key points, some key takeaways, things that I learned today, the actual rate of return versus the average rate of return in your instruments, in your financing instruments. There's a big difference. Make sure you understand that difference. And I think the big takeaway here is there's so many different ways to look at financing an acquisition or the growth of your business. And the infinite banking concept might not be for everyone, but maybe it's something that is interesting enough that you want to check it out and give Jim a call. All of today's information will be available in the show notes. If you would like to learn more about the process of acquiring or selling a business, please visit us at sunacquisitions.com, or feel free to reach out to me at drinaldi@sunacquisitions.com. I look forward to seeing you again on the next episode of the M&A Unplugged podcast. And until then, please remember that scaling, acquiring, or selling a business takes time, preparation, and the proper knowledge.
Thank you for joining us today on M&A Unplugged. If you enjoyed the show, please subscribe, rate, and recommend it wherever you get your podcasts. If you want more great information on how to scale, acquire, or sell a business, please visit our website at sunacquisitions.com.